Nike is falling and dragging on the Dow after Barclays downgraded the stock to equal weight. Volatility in China and weaker demand in North America, two reasons for the move. Also some worries about inventory. We've got the analyst behind the call. Adrian Yee joins us now. Adrian, so you're downgrading to equal weight, $110 price target. Nike's trading at 102, so it does feel like a little bit of a catch up or catch down kind of call.
Yeah, the price target that we have is at the end of next year. So it's kind of, we roll out it's more like a 15-month price target. So I think there's a lot of volatility during that 12 to 15 months. I think the near term is probably the next couple of quarters are going to be very tough. They have excess inventory to work through in the North American market. And really, the recovery, if there is going to be a recovery in stock price, margin, and EPS, it's going to be in the back half of calendar next year.
So Nike reports earnings next week on Thursday. You're expecting it's been a few tough quarters here. You're expecting more pain?
It's been 5 consecutive tough quarters. Remember, this all started in March of 2021 with the PR issue that they had. And then it's just been a rolling kind of one thing after another, right? They had the factory shutdowns with the massive exposure to the Vietnam market for the back half of last year, the supply chain issues. They finally caught up with that inventory. And so all that inventory that they bought, excess weeks of supply, it all showed up in May of this year. Just at a point in time, right, this last quarter through the July, reports that we've seen from retailers has been abysmal. It's been, one day after another of demand destruction in the North American market, in the U.S. market. And so that's really where we see the risk. If you look at their inventory, they actually, extracted by region. And there's a lot of inventory. Inventory in the North American market is growing 40% faster than sales.
So the problem, Adrian, the flip side to your argument and why so many of your colleagues stick with Nike and are so bullish, because if you talk to the company and you listen to the company, they've still got really strong brand heat. They're not having a problem with demand, and they're outperforming both Adidas and Under Armour on certainly sneaker sales, but also apparel. They've still got the style, and they're still resonating with the consumer. Everything you're talking about is related to macro and COVID and some of these other external pressures. And so as long as they can continue to maintain brand heat, then that ultimately should benefit. That's the flip side argument that you hear from a lot of the analysts.
And I would wholeheartedly agree with that over a multi-year horizon. Unfortunately, investors have, near-term 12-month targets, end-of-year targets. I think that the next, the rest of this calendar year going into next year and even into 2024, remember the way that wholesalers make their business. And although Nike is trying to move to DTC as quickly as possible, they still generate 55% of their business from wholesale. Wholesale is the next shoe to drop. Frontline retail, right, is having its toughest demand-destroying year from the consumer this year. They buy from their vendors about 6 months out. So, just in general, the weakness that we would see, it would not be showing up today. It would be showing up in spring of 2023. And that's what we're worried about.
Yeah, but it's a kind of bearish view there on top of a 40% plunge in Nike stock this year. Thank you, Adrian, for joining us to discuss it. Adrian Yee.